This is Macro Voices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Macro Voices episode 372 was produced on April 20th, 2023. I'm Eric Townsend. This episode of Macro Voices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Rosenberg Research founder David Rosenberg returns as this week's feature interview guest. Rosie says the bottom isn't in yet for the stock market, and the long-awaited recession has finally begun now. We'll also discuss precious metals, bond yields, and FOMC policy.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, April 19th, 2023. The S&P 500 was up 1.2%, closing at 4178. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 0.4%, closing at 101.94. Dollar is reflexively rallying after testing a key support. The June WTI crude oil futures contract down 4.6%, closing at 79.24. We're seeing now deeper version of the recent strength. We'll look at that chart, and Eric will have the EIA inventory data in the postgame. Gold down 0.9%, closing at 2007. Stalled on the week-over-week advance, but the bull trend remains intact. Copper flat on the week, closing at 408. Uranium up 0.2%, closing at 51.20. U.S. 10-year Treasury yield up 19 basis points, closing at 359 points. The key news to watch on Friday is the release of the flash manufacturing and services PMIs. And next week, we have another big wave of corporate earnings and the Bank of Japan monetary policy statement. This week's feature interview guest is Rosenberg Research founder David Rosenberg. Eric, why did we get Rosie back on the show this week?
Well, Rosie is a listener favorite, and we were overdue to get him back. It's been quite a few months since the last time we had him on the show.
Well, Eric's interview with David Rosenberg is coming up as Macro Voices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Rosenberg Research founder David Rosenberg. Rosie, it's great to have you back on the show. It's been way too long. Let's start with the big picture. We're climbing away here with what some people think is a recovery to maybe new all-time highs in the stock market. I'm skeptical myself. How do you see this market? What lies ahead?
Well, we have a long way to go to get back to those early 2022 highs. So that'll be a bit of a stretch. I think that the markets, whether it's the equity market or whether it's the credit market, has gone into pricing a soft landing. So I think that they've more or less bought into the Jim Bullard view from the Fed, that all is good, the business cycle's been repealed, there is no recession, and the green light is there to bid up the forward multiple back almost to to 19 earnings. So this is a very expensive stock market right now, and it's priced for Goldilocks. So all of a sudden, recession apparently is off the table, and investors are embracing the soft landing once again.
I have a feeling, David, that you are not quite as sold on this idea as some others are, that it's all uphill from here. What's your outlook, and what do you see on the horizon?
Well, I'm seeing the tea leaves as being that a recession is actually already starting this quarter. And you could see that being built in from the negative retail sales volumes numbers that we've had in February and March, the negative reading in March industrial production. The labor market is mixed. The headline non-farm payroll numbers have continued to be positive, but at the same time, the leading indicators of employment, such as temp agency jobs, they're coming down. And you know historically that when the headhunters are chopping heads, the rest of us aren't usually that far behind. The work week is a classic leading indicator of employment because companies tend to cut hours before they cut their staff, and the work week is in a notable downtrend. That gets very little play, and the work week, by the way, is one of the components of the Conference Board's index of leading economic indicators. And of course, initial jobless claims have all of a sudden started to ratchet up. They are up 50,000 from the cycle lows. And if you go back, the last time we were up 50,000 from the cycle low before the pandemic was heading into January 2008, when the recession was just starting, and yet the consensus back then was that we were in a soft landing. So much like the sentiment that we're seeing right now. I guess my fundamental view is this. I come from the school of Albert Einstein, although I'm not a physicist, but Einstein famously said that the power of compound interest is the eighth wonder of the world. So I've always believed that interest rates matter in both directions. It's interesting that when the Fed is cutting interest rates and steepening the yield curve, everybody is just talking about recovery in a bull market. When the Fed embarks on the most aggressive tightening cycle since 1981 and inverts the yield curve, well, we can just somehow ignore that. But the cycle is the cycle. The rate cycle, the market cycle, the economic cycle, they are these centrifugal forces, these sine waves that intersect over time. So I would just say to the people that disagree with my view, which they're well entitled to, a lot of people do, that you de facto are acknowledging that not only is it different this time, but that the business cycle has somehow been repealed. I don't believe the business cycle has been repealed. I believe interest rates matter. I believe that there is tremendous value in information from the yield curve, but it tends to lead by roughly 10 to 12 months. And the yield curve started inverting for good last July, so do the math. And it's telling you that the recession should be arriving on time, basically the quarter that we're in right now. So that's my big picture view. I think that at this stage, looking at where credit spreads are, looking at the big backup recently in 10-year Treasury note yields and the 2-year note pricing in another rate hike in early May, and now we're started building towards another one after that in June. Just the more the Fed has to do now, the more they'll have to cut rates down the road. But suffice it to say that an economy that is driven by credit, and now we not only have the cost of credit having gone up substantially in the past year. This is the most aggressive tightening cycle since the Volcker years of the early 80s. We now have question marks over the availability of credit, the access to credit, in the aftermath of not one but 3 bank failures last month. And there's going to be more chapters to be written, even though the authorities, the Fed, have managed to backstop deposits and prevent a contagion. What they will not be able to do is stop the banking sector from focusing on their balance sheets, focusing on their capital, and restricting their access to credit, which is going to have a layered impact on the downside towards the economy in the next several quarters. That development is only now just starting.
Let's talk a little bit more about interest rates. Last time that we spoke to you, you said that the peak was in for inflation. Seems pretty clear that, at least with respect to the pandemic-induced inflation, that has peaked now. But is there a new secular inflation trend that we need to be worried about, or are we headed back down below 2%?
Well, we won't know the secular story for years or decades because by definition, secular means long term. And a lot of that has to do with the view that there are shortages of everything, shortages of material, shortages of labor, and that the world is deglobalizing. And there may be truth to that. We just don't know. That's going way out into the future. I think that story on secular or structural inflation is way overdone. By the way, we were hearing the same things after Donald Trump got elected in 2016, that blowing a hole through the fiscal deficit through $1 trillion tax cut and restricting immigrant labor was going to create the conditions for secular inflation. We heard that back 7 years ago. Somehow it never materialized. So I guess I adhere to one of Bob Farrell's 10 market rules to remember that there are no new eras, excesses are never permanent. And so I think that, the situation with inflation is that the inflation is not the CRB index, it's not the S&P 500, it's glacial. It took a long time for inflation to go from where it was to 9% in June of last year. It'll take time for inflation to go down. Inflation is a process. It doesn't fall like a stone. It doesn't do a bungee jump. And everybody is just so impatient about getting down towards 2%. It's going to take a while to get down towards 2% the way the CPI is constructed. But I think that inflation, as you said, it has peaked. It is coming down. It's like a race for an economist, very exciting race between watching paint dry and grass grow. But I think that inflation is going to be coming down. I think it's going to be coming down in the good side, and you're seeing that in the broad commodity indices over the course of the past several months. You're seeing it in freight rates and transportation costs. What is still frustrating in the CPI data is the rental components, which is 30% of the index. So as rents go, so will inflation. And there are these 3-year distributive lags in the rental component. So a lot of the rental inflation, which is stubbornly high, is still reflecting leases that were being signed, 2 and 3 years ago when there was no supply and rental rates were going up. But that will come out of the data eventually, perhaps as soon as the second half of this year. The one thing I will tell you, and of course today we just got the housing start data for March. When you're taking a look, for example, at multiple units under construction, they're at a record high. They're up 60% over the course of the past year, and they're running about 960,000 an annual rate. These are units under construction in the rental industry. So there's a massive pipeline of new units coming on stream at a time when the nationwide apartment vacancy rates are already gone from roughly 4% to 7%, and you're seeing in real time rents have been either deflating or disinflating. That hasn't shown up in the CPI data yet. And when it does, I think people will be surprised, and this might be more of a story for next year, how low inflation is going to go. So I'm in the camp that thinks that secular inflation, that's a wait and see. That's a show me situation. We've heard it before. But I think that if you have a 12-month view, inflation is going to be coming down quite significantly.
David, the last time, or maybe it was the time before that when I spoke to you, you emphasized don't give up on gold. And at that point, we were plumbing 1,600 and something. Needless to say, that was a good call. But now that we're back up approaching all-time highs in gold, still over 2,000 as I'm speaking right now, are we done here? Do we already have the big bull market in gold, or is it just getting started?
Well, it's the chart. The chart looks great right now. You could argue, if you're into the technicals, that it's overbought on a near-term basis. But I think the fundamentals for gold are going to remain very positive. Now, you got to consider that the two most important determinants fundamentally for gold are real interest rates and the dollar. And the Fed has continued to raise rates, saying they're going to raise rates again in early May. And now the swaps market is pricing in about a 25% chance that they go ahead and move again in June. And so this is what gold has done in that environment. The dollar has weakened, but hasn't yet broken down. We are soon on the precipice of seeing the 50-day and the 100-day moving averages converge. That would be a bearish technical signpost for the greenback. So there's two things that are going to happen in the next several months that make me very excited about gold. I think the Fed is going to be stopped in its tracks. I think the data will force the Fed to stop in its tracks, and then the market's going to go ahead and price in even more rate cuts into 2024. On top of that, because the ECB is playing catch up to the Fed, the BOJ hasn't even done anything yet. A lot of these central banks will still be tightening monetary policy at a time when the Fed's on hold and then pivoting towards easing monetary policy. And the most important determinant of currencies are relative interest rate differentials, which are going to work against the US dollar. So the future, if we can define the future, not secular, let's take it a year at a time. Hopefully you'll have me back on before the next 12 months. But let's just say if you said you got to give you a 12-month view, gold's going to go to new highs and not based on anything other than lower real rates and a weaker US dollar. And those are the only ingredients you need to be bullish on gold.
I'm fascinated by your emphasis on those being the only ingredients you need. A lot of people are starting to focus again on this de-dollarization story, with more and more central banks around the world questioning whether or not they're completely committed to U.S. dollar-denominated reserve assets. Is that part of this, or is what's driving gold have nothing to do with de-dollarization?
I don't really think right now it has a lot to do with it, and I think that's, again, another scare tactic that yes, you're finding, whether it's Russia, Saudi Arabia, Russia, Brazil, China, beginning to form some sort of currency block where they are reducing their reliance on the US dollar. But the reality is that the dollar share of reserves globally and the dollar share, the US share of global trade globally, has been going down for a considerable period of time. And the stuff you're mentioning was happening when the dollar was in a raging bull market last year. So that doesn't really factor into it. I just said that, when you're trying to model, gold, those two important variables, real rates and the dollar, you can actually run a model based on those two. Look, there's other things happening right now. I don't know so much about the what you talked about, the de-dollarization. Maybe that's accelerating, probably true. The fallout from the U.S. government freezing those Russian reserves, less trust in, then again, all the U.S. government did was punish bad behavior, be that as it may. It comes down to a trust issue. That might be true as well. I'm not so sure that's really what's behind the move in gold. The move in gold is really, the first move has been because the market, even though it's pricing in May and June, the markets realize that the Fed is very close to the end game on raising rates. That removes a major albatross across the neck of the gold price. And then the next move would be to cut interest rates, and that isn't even fully priced in. For the end of the year, a couple of cuts priced in, I don't think nearly enough. And I think the US dollar is going to go down. We can build the horror story of de-dollarization and all these countries around the world ganging up against the US dollar. Okay, if that's your story, run with it. Maybe that's a cherry on the cake for the gold view. But I'm just saying, what is staring me in the face fundamentally? Lower real rates, lower US dollar. I suppose that if I was going to be looking at anything globally that is supportive, it's that the global central banks are diversifying more into gold. And that's also because they have deep pockets. And that's also something that investors should be comforted on. And if we see a near-term pullback on technical reasons, because it is near-term overbought, it's going to be a great buying opportunity.
Let's talk about China. To what extent does China's recovery factor into the overall global macro outlook? Some people are saying, the China recovery is going to make all the difference in the world. Other people are saying it's not that important.
Well, it's a great question. We had data today for China. Their March retail sales numbers were huge. Their industrial production numbers were very weak. So the bottom line, and of course, all you have to do is just look at the latest IMF forecast. The global economy is cooling off, with or without China. And that impact is having a downward pull on the manufacturing sector in China. And plus, they're still working their way through their debt morass and the bursting of their property bubble, which thankfully looks to be running its course, but is still not a source of support for the economy. Is the China reopening enough to produce a boom for the global economy? I think it's just very selective sector-wise. I think it's obvious that the reopening of the Chinese economy is going to be a big boost to travel and tourism within Asia itself. So you could say, is that bullish for airlines? Sure. Is it bullish for jet fuel? Sure. What does it mean for the average Joe or Jane in the United States? Well, not that much. You could draw a line and connect some dots between Chinese now being able to go and visit Europe and go shopping in Europe and buy all those Gucci bags and all the high-end luxury goods that Chinese consumers like to buy. So you can formulate some sort of equity strategy out of it. I think you're going to get a near-term lift, obviously, from the services side. But, what impact is it going to have on the production side? And we're not seeing much of a lift there at all. I think a lot of that is because the global economy is fragile and is softening. And so you're seeing this dichotomy right now between the service sector in China, which is lifting off, and the goods producing side, which remains fundamentally weak. So I think it actually comes down to, call it a fractionally positive boost for global GDP. I think it's a much probably bigger regional impact on cross-border trade and tourism flows within Asia itself. That's where the action would be. If you're going to turn this into a bullish story, it's really an intra-trade tourism travel story within the continent.
David, let's go back to the stock market outlook. You expressed a fair amount of skepticism earlier. Do you think the bottom is in for the S&P at 3,500, or do we still have new lows to come once we get into the recession that you're talking about?
Well, I think the only way that you could believe that the lows from last October are going to hold is if we manage to come out of this without a recession. And the market right now is telling you that David Rosenberg is wrong and the soft landing crowd is correct. If you believe in the soft landing, then maybe you're even right. Maybe we go to new highs. I don't think that's going to happen. I think that a recession is staring us in the face. So if you're true to your view, and at any moment in time, all the stock market is, every single second, millisecond, minute, hour, the stock market's just a product of two numbers. It's earnings and the multiple. And so if we get a recession, a classic plain vanilla recession, mild recession would still mean a 20% hit to earnings, which then takes you to something close to, call it $185 EPS. Then the question is, what's the recession multiple? Well, a recession multiple is not 19 times forward earnings, where we are right now. Recession multiple is closer to 16. So if you do the arithmetic on recession multiple and recession earnings, I hate to say it, but you're down towards to 3,000 on the S&P 500. And I'm not that good that I could isolate what day that's going to happen, except to say that is the endpoint for the bear market. And I'm hoping the sooner the better, because I'd like to turn bullish again. But that's where I would say that we'll go to in a recession that right now is not remotely priced in. I'll tell you right now that a recession was never fully priced in. And now we've gone from not just remotely pricing in a recession to fully pricing in a soft landing. And that's pretty dangerous because, like I said before, if you're chasing this market at this point, at these multiples, your belief system is that we have repealed the laws of the business cycle. So, I'm still bearish on equities. We are in a significant bear market rally right now. Over a month ago, we were talking about a new leg down because of what was happening in the banking sector. But there's still more chapters to be written on this. We have not seen all the policy lags from what the Fed has done in terms of the rate hikes. The economy responds to rate hikes with lags that are fairly long. We haven't seen the full impact yet. So I think that when the recession becomes a reality in investors' minds, and look how long it took a long time in 1990 for the markets to recognize recession. Look how long it took in 2007, 2008. We'd be having the same conversation after Bear Stearns got swallowed up by JP Morgan in March of 2008, and the market took off after that. And we'd be having this discussion. You'd be asking me at that point, have we hit the lows? I'm pretty sure when I was at Merrill, I'd say, no, I'm pretty sure we haven't. So I think that's really what the story here is. Where is your multiple? Where's your earnings number? And when you consider 16 multiple, classic recession trough, 19 right now, okay. And we're not even halfway through the earnings downturn, and earnings have turned lower. So I think when reality sets in, when Wile E. Coyote looks down, the market's going to go down to new lows. We're not just going to test the October lows of last year. We're going to go through them.
Okay, so we've got a fairly bearish outlook based on what I'll call the recession model of the market, which is where do we stand right now in the economic growth and recession cycle. But there's also a credit cycle, so let's talk about that next. Should we be concerned still that this Silicon Valley Bank and then Credit Suisse, are we in the beginning of a new 2008-like credit crisis, which is about credit? Or is that pretty much over now and wound down with what we've seen with Silicon Valley Bank and the other scares that we've had so far?
Well, let me answer maybe the middle question first, which is that no, it's not 08 or 09, and lightning doesn't strike twice. And the large banks are in fine shape. They have capital buffers, strong liquidity, and they're so heavily supervised and regulated and monitored today that the big banks in the U.S. look like the big banks in Canada. So they're fine. We do have a situation with the small banks, the regional banks, and the small banks aren't so small anymore. And they are loaded up the wazoo with commercial real estate debt, which is, last cycle was residential mortgages. The cycle before that was .com. This cycle, the bubbles in commercial real estate. And now you're seeing vacancy rates above 18%, rents coming down, prices imploding, and defaults are on the rise. So the next shoe to drop is commercial real estate. And although practically every bank has large exposures, the big exposures are at the small banks, but the small banks have taken up over the past decade an ever greater share of outstanding credit in the economy, because for so long the big banks were penalized. And so that's where the problem is. It's not going to be 08, 09, but I don't think we have to draw that comparison. What we have to do is just become rational thinkers. Let's put aside the catastrophe scenario, which I don't think is going to happen. I think what's likely to happen that will still have important downside economic impacts is that the banks are doing what they're doing already. They're going to be raising their loan loss provisioning, and they're going to be restricting access to credit. Maybe not to their most credit-worthy borrowers, but almost everybody else who is not that credit-worthy. And remember that recessions always operate at the margin. Small changes in a big economy. The level of GDP is always huge, even in recessions. Recessions are about rates of change. And I think that coming off what was a massive increase in interest rates, which is going to have a continued impact on debt servicing costs for the economy. Now, keep in mind that a lot of the run-up in the debt servicing costs from the Fed were absorbed for much of the past year from the lingering impacts of all the fiscal stimulus and all those checks that were sent out, back in the winter and spring of 2021. That's already basically done. So the full impact of what the Fed's done is going to come into fuller view at the same time that the banks are going to be constricting credit. I think that if we were to draw some sort of probability curve of outcomes, I don't think we're going to have a massive, 08, 09 event. I don't think it's going to be, outside of commercial real estate, that's a big problem, but it's not enough to create something that you would call a great financial crisis or the Great Recession. Everybody likes to draw the comparisons to 08 or 09. That was a one in century event. So maybe we'll wait another century. However, the situation that evolved with Silicon Valley Bank is a reminder to the banking sector writ large that their capital is precious. And they're going to most likely be tightening their credit standards, which they were doing, by the way, even before this crisis took hold. This is going to cause the banks to become that much more circumspect. So I think we're going to go through a variation of what we had back, say, in the early 90s coming out of the savings and loan debacle, which, by the way, no big bank failed. There was no massive contagion, although we shuttered a third of the savings loan industry, but it had an impact on credit creation. And we had a 3-quarter recession. It wasn't the end of the world. The Fed took the funds rate from 9 7/8 down to 3%. We had a workout period because there wasn't much of a recovery after that 3-quarter recession. But by the mid-1990s, Netscape goes public. We have the internet, and we're off to the races again. So we're not going to be talking about Silicon Valley Bank, or we're not going to be talking about anything we're talking about today, 2, 3, 4 years down the road. But there is going to be a near-term impact, at least over the next year, in terms of a constriction of bank credit coming out of this. That's going to add downside risk to the economy. That much we can almost say with certainty.
We spoke about precious metals earlier. Let's talk about commodities more broadly. We're seeing a lot of interest in copper, in battery metals. A lot of people are putting big commodity bets on around energy transition. Is this part of a secular trend? Is it just a fad? Where are commodities headed from here?
No, it's not a fad. And I think that, what you're seeing already, even during whatever period we had where there was all this recession talk, commodity prices came down, but not nearly to the levels that we had in the past, when we had similar, economic malaise. It's hard to sit here and say, be all bulled up on commodities as we go into a recession. So on a near-term basis, I'm not bullish on commodities because there is a structural supply curve that's very positive for oil and for the entire commodity sector and the greening of the world and electric vehicles expanding. And so there's this natural demand that didn't used to be there for the commodity sector. That much is true. And of course, it's a sector that's been starved of capital and supply constrained for so long that you have this what in economics we would call an inelastic supply curve. So that's very supportive for the price. But there's also the demand aspect of it. And if we go into a recession, which, by the way, the IMF pretty well told us that if we're not heading into a recession, we're heading into something close to a recession. Even with a very powerfully positive, supportive supply curve, I think the demand will take commodities lower. However, if you have that secular view, let's define that. Let's say it's a 3, 5, 10-year view. Commodities are probably going to be in a bull market for an extended period of time. And I think actually, once we get past the recession into the recovery mode, and then we have the demand bumping against the inelastic supply curve, commodity prices are probably going to go up quite a bit. Now you'll say to me, but how does that fit into your low inflation view? Well, because there's a whole lot of other things that are going to be happening at the same time. And keep in mind that we're going to be going through a considerable period of time where rents are going to be deflating. The same rents that spent the last 2 years inflating and juicing up the CPI are going to mean revert in the other direction, and I think have more of an overwhelming impact on the inflation picture. Because remember, 60% of the CPI is services, not goods. It's true that we eat. It's true that we buy furniture and clothing and appliances and we drive. Only 40% of the CPI is in goods. 40%, 60% is in services. And guess what dominates the services? Housing. And house prices, what are they doing? Going down. Residential rents in real time, what are they doing? They're going down. And that process is going to go on for the next couple of years. And that's going to have a dominating impact on what's happening on the goods side. But if you're asking me about commodity inflation, once we get past the worst point of the economic cycle, I'll write reports on that. The prices are going to go up rather significantly.
Well, David, I can't thank you enough for another terrific interview. But before I let you go, I want to talk a little bit about Breakfast with Dave, the newsletter that you've been known for literally for decades, since your Bank of Montreal days, back more years ago than probably either one of us wants to admit to remembering. It's changed a bit, though. Since you formed Rosenberg Research, you don't have this have to be bullish all the time bias being held over your head. And that's changed the services or broadened the services that you offer. So tell us a little bit more about what's on offer at rosenbergresearch.com.
Yeah, look, that's a fair comment. We're always looking for ideas and opportunities to put money to work. So the work we do, look, we span all geographies, and we span all the asset classes, and we have investment recommendations. And on top of Breakfast with Dave, we have a monthly asset allocation model called Strategizer that we publish every single month. So people that say, well, he's a one-trick pony, it's always either or two. I guess it's always about bonds or it's about bullion, the bond bullion barbell for the alliteration. But we actually have a slate of ideas that we're always talking about. And so Breakfast with Dave, we've it's not what it used to be. It's actually more, because it's chock full of ideas and new ways of looking at the world and looking at the markets. So it's a little thicker than it used to be, more quantitative than it used to be, more model driven. And that's because, as you said before, you're right. I'm not linked to an institution. I'm not on the buy side or the sell side. The only thing I have to sell and what people could buy is basically my view, or I should say our collective view, because what's really changed is I have a whole team behind me, and a good chunk of that team are terrific, quantitative, model-oriented individuals. And the name of the game is to help investors make decisions. So, thanks for the plug. Breakfast with Dave is still the flagship, but I'll just tell you what's changed at Rosenberg Research is that our monthly Strategizer asset allocation investor publication now rivals Breakfast with Dave in terms of client demand. That's something that just happened in the past couple of months.
Dave, I know you've been kind enough, again, as you said, it all starts with Breakfast with Dave, and you've offered our Macro Voices listeners a free trial. Please tell us a little bit more about what they can find. There is a link in the Research Roundup email, but for anyone who's listening who's not subscribed to Research Roundup, please tell them where they need to go in order to take advantage of this offer as well.
Great. Just come to the website and information at rosenbergresearch.com. And it'll take you right to the website, and you can log in there.
Okay, and at the website, rosenbergresearch.com, there's a free trial for the Breakfast with Dave newsletter.
Free trial for every viewer of today's show.
Fantastic, Dave. We look forward to getting you back on the show in a few months for another update. Patrick Ceresna, Nick Galarnik, and I will be back as Macro Voices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rosie back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to the chart deck. Listeners, you'll find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over David Rosenberg's picture that says Looking for the Downloads. Eric, let's cover crude oil, starting with the EIA inventory.
EIA inventory printed a drawdown of 4.6 million barrels, so fairly significant drawdown. Cushing, Oklahoma, 1.1 million barrel drawdown. Gasoline building 1.3 million barrels. Distillates drawing down 356,000 barrels. U.S. production holding unchanged at 12.3 million barrels. Tape action, the market had really taken a nosedive in the European session before the U.S. data even came out. Inventory was enough to arrest the plunge in the market, so it didn't continue any further. But it was not enough to turn the direction around to the upside, at least not so far.
Yeah, Eric, on page 2, I have the crude oil futures chart. And what we really saw, there was an attempt to break out of the trade range with that little push a week ago. But really what we've seen is a rejection at the top end of the range. And now we're filling that gap and backfilling. What's interesting is the fib retracement zones lie very close to where all the lows occurred in the last 6 months. And so the question is there still another $2, $3, $4 downside of crude? Generally, I think this trade range will still prevail, and that the dips should be bought here. But the question is that does it still have another couple dollars to go before that buying opportunity occurs? Nonetheless, what are you guys thinking on equities?
I'm still leaning toward the melt-up continuing for a while. If we get as far as 43.09 on the June S&P futures chart, then I'll short that level, expecting lower numbers before this is over. But I don't really have a strong view of whether we get all the way up there first before the rollover happens. Seems like more and more people, including Rosie in today's interview, are telling us, hey, second half, the shit gets real. That's when the recession really hits the tape. We're going back down in equity prices. Question is, how long do we keep drifting up before the top is finally in and we go back down? 61.8% retrace seems to me like the logical place, so I'm holding out for 43.09 before I would be bold enough to actually short this market, but I wouldn't be surprised if it rolls over before that.
So, Nick, on page 3, we've got the S&P 500 levels. What are you watching?
Spot right now is around 41.50 as we speak. There's a call wall above at 4,200 and a put wall at 3,800. Right now, the implied move for the May 19th OPEX, which is about a month away, is 140 points up or down. So the upper expected move is 290 approximately. Lower expected move is around 40.10, right above that support of 4,000. Key support is 4,100 and then 4,000. Key resistance area is 4,200. Interesting to note as well that this year, the S&P is up about 8%. And right now, there are about 20 companies that have made up 7.55% of that return. So there's Apple, Google, Amazon, Microsoft, NVIDIA, Tesla, Meta, and AMD, among others as well. So very, very interesting to note that because, a very small basket of names is carrying the market higher right now.
Yeah, what's interesting about that is the divergence also between small caps versus the NASDAQ. What we really saw, like you're saying, the leadership was in those big names. And because the Russell was filled with so many regional banks, it massively underperformed. And it was just such a huge laggard. And maybe that Russell is going to be a chart to watch in terms of when the markets are ready to roll over again. Now, on page 4, I have that S&P 500. And I continue to watch the two levels of overhead resistance. The market remains in bull trend. It's above all its moving average, above all the fibs, staying in that upwards trend. And that previous highs at around 4,200 have so far been the resistance points that has stalled all of these market advances. There is still room for one more advance toward 4,300. I know, Eric, you were talking about that fib zone that lines up with that August high. And it definitely the market can get up there. The key thing I would say, though, which is an observation just in terms of how resilient the bulls can still be, is the fact that even 100 to 150 S&P point drop would keep the market above most of its key moving averages, above the fib zones, and arguably can still be bought on dip. There's a lot of technical damage that needs to be done in order for the prevailing uptrend to be reversed, and therefore this could easily push into May. But one thing that will certainly make me more bearishly inclined is that when we do see bullish impulses higher, if they continue to show this divergent momentum and a lack of follow through by the bulls, and the breadth of the market continues to be incredibly narrow, it's going to make me start to think that the downside window is slowly opening up. Will it be one of these sell in May and go away windows? It's kind of
Patrick, it's very interesting you say that because I noticed the last 5 days on SPX, we've stayed in a very, very narrow range. The range has been about 17 points or so. We've closed right around that 4150 area for about 5 days in a row now. And seeing that before an FOMC event, which is in 2 weeks, I think we're going to see volatility pick up pretty fast. And you're right. It's possible we get upside to 4,300 or so. So I'm still short-term bullish, but longer-term bearish overall.
So let's move on to the NASDAQ on page 5. What are the QQQ levels you're watching?
So spot right now is around 317 on triple Qs. Call wall above at 350, put wall below at 270. Implied move for the May 19th OPEX, which is about a month away again, is plus minus 14 points. So upper expected move is 331 and the lower expected move is 303 approximately. Key resistance above is 320 and key support is at 300. Keep in mind the high of the year was around 335. So if we do push that upper expected move, that will take us right to near the year highs or so. And we do have earnings from Google next Tuesday, as well as Microsoft. Next Wednesday, we have Meta reporting earnings. And then we have Amazon and Intel reporting next Thursday. And then the following Thursday, we have Apple reporting as well. So the heavy tech hitters are coming out in the next couple of weeks. That same week that Apple reports, we also have FOMC on Tuesday and Wednesday. So there's going to be a lot of volatility-inducing events, I think, coming up the next few weeks or so.
Interesting that you bring up volatility-inducing events because when we look at page 6 on that VIX, what a surprising contraction of volatility. I mean, we are now seeing levels on the VIX that we haven't seen since 2021. And right now, essentially, the market's ranges have narrowed. Volatility premiums are very reasonable to buy downside hedges. And that really feels like nobody's worried about anything here. But it'll be interesting to see whether a short-term low comes in here on the VIX. What are you thinking?
Yeah, as I said last week, what we're seeing here is a lack of cash in the, being deployed in the market. So there's a lot of bystanders sitting on the sidelines, waiting to get in and waiting for a move in other direction. But right now, because of that, we're not seeing a lot of hedging to the downside with put buying, which is suppressing the volatility right now. So we're seeing some call buying, but not enough to push us higher, and almost no put buying right now for hedging. So that's suppressing the VIX. And as I said in the past as well, with the movement toward 0 DTE options versus the 30 DTE average options, the VIX is no longer perhaps as meaningful as it once was. Now on page 7, we have the US dollar index, which has seen a double bottom recently. What are you guys thinking we see going forward?
No change from last week. We're nicely holding in the consolidation zone. I don't see any reason to conclude that there's a really big new move down in the dollar unless and until we see a daily close below 100 on the Dixie, and we haven't seen that yet.
Yeah, Eric, the interesting thing for me here is there is definitely room for a couple more stabs on the downside, but generally I'm not as bearish the dollar as the consensus seems to be, and I feel that the prevailing trade range is far more likely to hold than another major leg down. At this stage, considering that the highs of the trade range are near 105 and the lows here are around 101, I think that seeing the dollar react and move towards the top end of the range has a very reasonable chance of occurring here. I'm far more neutral. It doesn't make me outright bullish the dollar. Simply, I think it's oversold. The support line has a very reasonable chance of holding, and we'll see whether or not we get a reaction here.
Now, guys, moving on to gold here on page 8, which is near all-time highs. I'm thinking we see a push higher and perhaps it's hit new all-time highs. What are you guys thinking here?
Well, the market is stuck between the round number support, used to be resistance, now it's turned into round number support at 2,000, and new all-time highs above the market. And let's say the resistance level above the market starts around 2060 up to 2080. One of those was the 2022 high, the other was the 2020 high. My prediction is that we will eventually get to new all-time highs, and when we do get there, I expect an acceleration of price movement to the upside. I don't think we're going to get there right away, though. It's just been so much so quickly for this market. It's never quite this easy. The market's got to make us work a little harder in order to earn our profits here. So I'm watching for a close below 2,000 to start a rout of lower prices before we eventually move higher to new all-time highs. We got the beginnings of that on Tuesday night, overnight into Wednesday morning when we were down to just over 1980, 1980. but then recovered to close over 2,000 before the close on Wednesday. I won't be surprised if the next move down ends up closing below 2,000 and starts a rout. And we've got plenty of room to the downside. As long as we stay over the 100-day moving average, which was all the way down at 1886, then we've got plenty of room here to say that the bull trend is still in play. So there could easily be $100 down before we eventually get the move to new all-time highs. But I do think that before the summer is out, we're going to have that move to new all-time highs, and we'll probably see a pretty substantial acceleration after that. Once you've closed over the previous all-time high, let's say above 2,100 to be safe, I think the trip to 2,400 from there will be very short.
Yeah, while I remain a big picture bull on the upside, and the way Rosie even said it, 1 year out, do I see higher gold prices? I'm in that camp. I just am not so sure that it's going to be all upside here in April and May. As we bump our head up into this overhead resistance, the idea that we could mean revert this really amazing 5-6 month run on the upside is, I think, a risk, and we're going to see obviously where that presents buying opportunities, but I'm not so sure that this is going to be all upside from here. Nonetheless, I want to move on to page 9, where I have the 10-year U.S. government bond yields. And while we've seen yields increasing here on the very short term, I just don't see the environment from which we see, at least in the short term, a push back up toward those 4% levels. And so I suspect that as we work our way higher here, that it's likely to reject maybe even just below 375. It'll be interesting to see whether it creates a short-term buying opportunity on bonds. Moving on, though, I wanted to just touch on the high yield bond ETF, the JNK, which I have on page 10. And while we have seen a bounce and a reaction higher, which is largely due to its correlation to equity, there has been a lack of follow through. And to me, if we see that this failed to rally back to 94, where its highs were in January, February, and it rolls over here, to me, this is a canary in the coal mine of when the next risk-off cycle could really get underway, particularly if it causes those credit spreads to start to blow out. That has not happened yet, but it's certainly something on my mind to watch.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of Macro Voices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the charts we just discussed here in the postgame, and a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @macrovoices for all the most recent updates and releases. You can also follow Eric on Twitter @Eric S. Townsend. That is Eric spelled with a K. And follow Patrick @Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.